Hey everyone, welcome. This is part 1 of Chapter 7. And in Chapter 7, we're going to be moving into profit planning, which really involves the process of budgeting. Let's get right to it. A basic framework about budgeting is that a budget is really just a detailed plan for acquiring and using either financial and other resources over a specific period of time. And we'll talk about those periods of time. And budgeting specifically is quantitative, so that we're talking about numbers over a specific period of time. Some of the terms you're going to see used in this chapter is, of course, budgeting, and that's just the act of preparing or creating a budget. And budgetary control is when an organization uses that budget on an ongoing basis and compares results going forward to make sure that we're actually following and sticking to the plan and or modifying as need be. Budgetary control. Some of the advantages of budgeting that are reviewed in the chapter is really one of the things is it gets a business to think about and make a specific plan for the future. We can define goals and objectives for our organization, which is really important, rather than just floating freely and not having any specific goals. It helps for us to plan specific goals for the future. It also creates a means for us to allocate our resources, and it can really help uncover bottlenecks in the companies and or areas where we're not being efficient, and ways to uncover specific and improve and enhance profitability. It also helps different parts of the organization coordinate their activities, and a way for management, including both senior management and middle management, to communicate their plans with their line employees. One of the things that's covered in the chapter is that when we're preparing budgets, obviously we want to create goals for managers, and you want to hold them to it. However, you want to make sure that they're only held responsible and accountable for those things that are actually within their control. I think it makes sense. You don't want to hold a sales manager responsible for problems that are happening in the purchasing department, for example. Now, one of the things that we'll be covering, generally there's annual budgets, but usually companies operate and create smaller period of time budgets, which are generally done on a quarterly basis. And that's what we're going to be dealing with in our examples here today, and also in the homework is quarterly. And of course, quarterly is just 1/4 of a year, so 3 months. And one of the things that the chapter talks about as well is the concept of a self-imposed budget. And what that means is you don't want senior level management coming up with the budgets and therefore the goals and requirements that the lower level managers have to make without getting their input in it. You want those management, the middle management and lower level management, to actually be involved in coming up with the budgets and coming up with the goals. Now, obviously, you don't want to give them complete authorization to control their own budgets, but you do need their input so that you get realistic goals for them. And by the way, you won't be coming up with any budgets, but it's real important, and I wanted to cover that so that everyone understands what goes into budget. These are really important, and all of you that go into business are at some point or another, and potentially a lot, going to be exposed to budgeting and plans. So it's real important, that first learning objective from the chapter. I did want to go over it, but in practice, you won't be going through any of that. You won't be preparing budgets in either the homework or the exam, but again, I want you to be aware and familiar with those concepts. So in learning objective 2, we actually get started with preparing a budget, and we're going to start with a sales budget and kind of a separate expected cash collection schedule, which is a real key part and something that you will often see out in business. So for our example, we're going to use a company called Royal Company, and we're preparing our budgets for the quarter ending June 30th. So the months of April, May, and June. That's the budget we're preparing for. And again, we're looking forward. We want to assume we're doing this before April 1st. And budgeting sales for the next 5 months are as follows. So, all right, we're given this information. We expect to sell 20,000 units in the month of April, 50,000 units in the month of May, and 30,000 units in the month of June. July and August are given here, but remember those are a little bit of red herrings. We don't care about those for now, right? We only care about the months of April, May, and June. And we're going to assume that our company sells only one product, and that our sales price is $10 per unit. So the key elements we're going to want here is the $10 sales price per unit and the amount of units we expect to sell in the 3 months we're covering. April 20,000, May 50,000, and June 30,000. And we're going to take those amounts, the April 20,000 that we expect to sell, multiply that by the sales price per unit, and that's the total budgeted sales that we are expecting, $200,000. Same thing for May. Take the number of units multiplied by the sales price, and that is the total budgeted sales we expect for the month of May. Same thing for June, and we can come up with a total for the quarter, right? Both in number of units we expect to sell, 100,000, and $1 million in total sales that we're expecting for the quarter. But real important to remember these, and this is handout number 1 for the class today, just so that you can refer back to the sales budget, because we are going to need this information. This information is going to drive the next 2 budgets we're going to be looking at. So moving on to the expected cash collections. What I want us to assume for this example is that our company, Royal Company, all of our sales are done on account, so nothing is done in cash. Also, our expected collection pattern is that we collect 70% of the sale in the month of the sale itself, then we collect 25% in the month following the sale, and the remaining 5% of our sales generally is uncollectible. We have some amount of bad debts. And then another thing for us to assume is that on March 31st, the day before our quarter begins, right, April 1st, our accounts receivable balance is $30,000, and we expect to collect all of that in full in April. And that's where I like to start generally, is whatever the accounts receivable are, if we expect to collect that, each example and hypothetical we work with will give you this amount, right? An accounts receivable and when it's going to be collected. And it's telling us it's going to be collected in full in April. And in the schedule of cash collections, we want to know exactly how much cash we're going to be collected. So let's start with this one where they give it to us. The $30,000 will be collected in full in April. And this is how you prepare the basic format of a expected cash collections. You want to list out your months across the top, and you want to have a total for the entire quarter, for the 3 months that we're working with. So again, we were told that the accounts receivable that we have on hand on March 31st will be collected in full in April. So let's go ahead and write that. That's given to us. Then we need to figure out how much is going to be collected in April otherwise. And this is where we need to refer back to our sales expected in April, right? So we're going back to the original sales budget that we created, and we expect $200,000 of sales in the month of April. Now we know that we collect about 70% of that in the first month and 25% of that in the next month. So we're really just going to populate those amounts. The $200,000 sales multiplied by 70% that we expect to collect in the month of April. By that same token, we expect to collect 25%, the next 25% of that 200,000 in the following month, the month after those sales. And since we're looking at sales from April, the following month will of course be May. And so now we've got the total that we expect to collect for the month of April, right? The old debt that we expected to collect in the month of April, the $30,000 plus, when we make all those sales, we're going to expect to collect 70% in that same month. Add those up, and we've got a total expected cash collections for the month of April for $170,000. So now let's go ahead and move into May. And again, remember, we already have a piece of May, right? From the April sales, we expect to collect some of that in the month of May. Now let's see how much we're going to collect from the May sales, which again, we'd have to refer back to our sales budget. And we're expecting to sell $500,000 worth of sales, all on credit. So we need to apply those collections amounts. Again, the 70% in the month of May and 25% in the month of June. do the exact same thing there, right? $500,000, apply that 70%, multiply that out, and we expect to collect that in May. And thereby, we have our total collections expected for the month of May, which is $400,000. Of those May sales, remember 25% of that is going to be collected in the month after, which would be June. So we go ahead and populate that amount. And once again, we've got to refer back to our sales budget. So that we know the amount of sales in June. It's going to be $300,000, and again, we apply that 70%, which we expect to collect in the month of June. We don't necessarily care about the 25% we're going to be collecting in the next month because that takes us out of the quarter. So we're really just going to be applying that 70% that we expect to collect in the month of June. Not to say that it's not important information, but it doesn't apply to this quarter, the amount that we're going to collect in July, right? That 25% of $300,000. That will be necessary for our next quarter budgeting. But right now we're just focusing on the one. And then of course we've got a totals column over here for the quarter, which will add up all of the collections. So all of the cash we expect to collect during the quarter. This is of course a key piece of budgeting and planning because oftentimes companies will be forced into bankruptcy if they cannot pay their bills on time, right? Creditors can force companies into collections if they fall far enough behind. So real important as a company to make sure that we've got enough cash on hand to meet our obligations. And a key part of that is going to be making sure that we have at least an idea of what we expect to collect in the future. Which brings us to the preparation of our cash budget. Again, given the importance of cash and making sure that we have enough operating cash to actually meet our obligations, it's real important that we plan out very specifically how much cash we expect to have, how much cash we're going to need to meet our obligations, and what the overage or underage is expected. Cash budget is divided into 4 main sections. Cash receipts, that's money coming in. Cash disbursements, which is money going out, and all we care about is actual payment of cash, not necessarily expenses like depreciation and amortization. Look out for those. Those are key hints for the homework and for the exam. If it doesn't involve cash, it doesn't belong on the cash budget. So that's part 2 is cash disbursements. Then part 3 is really just a subtotal. Do we have an excess or a deficiency that we're expecting based upon the inflow of cash and the outflow of cash? And finally, if we have a deficiency, then we're going to need to borrow money, right? And that's the financing section. Or if we've already borrowed money and we're going to have an excess of cash, then we want to pay that back to lower the amount of interest expense that we're paying. Most companies are generally going to have a line of credit, and that means they can access cash and take loans very easily and very quickly. Now, those things are very convenient and beneficial for companies to meet their obligations. However, they can also generally carry with them a very high interest amount. So we're going to want to pay that back as soon as we possibly can, but we want to make sure that we have enough cash on hand to meet our obligations and not go out of business. So in our example, Royal Company, we're going to assume maintains an open line of credit of $75,000, so we can borrow $75,000 very quickly and very easily at a very high interest rate of 16%. Now, our company maintains a minimum cash balance of $30,000, so if we do not expect to have $30,000 at the end of a month, we're going to need to borrow off of our line of credit in order to maintain at least $30,000. We're going to also assume that if we borrow money from our line of credit, we borrow on the first day of the month and we repay our loan on the last day of the month. And the reason I do this is simply just to make interest expense and cost calculations much easier to do on a full month basis than a partial month basis. We're going to assume that we're going to be paying a cash dividend of $49,000 in April, and we're going to be making purchases of equipment for $143,700 in May and $48,300 in June. Both are going to be paid in cash. And on April 1st, we're going to have a cash balance of $40,000. Now, all this is doing is telling us some of the key components, some of the big spending we're going to be doing, and I'm not including everything here, and the beginning cash balance, which is absolutely necessary as of April 1st. So let me show you what a cash budget looks like. Once again, we're going to have all the months that we're looking at in the quarter, and we're going to have a total amount for the quarter. Now, everything isn't a straight total, and the book discusses this, and I think you guys will have a good job figuring this out. I'm not going to go over which ones are totals, but I want you to really focus and use this as a mental challenge to see which ones are totals and which ones aren't, and why not. But so the first thing we're going to populate is, of course, the incoming cash and the cash we already have. So we start with the cash that we already have, the beginning cash balance, which was just given to us, of $40,000. Add to that the cash collections, and this is going back to what we just did, right? The expected cash collections from that expected cash collection schedule. Let's take a look at it. This came from our expected cash collection schedule, which we just prepared, right? We're expecting to collect $170,000 in the month of April, so that needs to come into our cash budget. And that's our total cash coming in. Then we're moving into the next schedule, right? And it's everything we expect to spend, right? All the cash we expect to spend. Remember, we do not care about expenses that do not involve cash, things like depreciation and amortization. Hint, hint, hint. Look for that in your homework. You're going to be given a couple expenses that do not involve expenditure of cash. We do not put that in here. All we care about for this cash budget is cash coming in up here and cash going out down here, right? And we're going to put all the cash going out in this section here, this cash disbursement section, except for payments related to financing, so paying back our loans. And we're also not going to put money coming in that is related to loans up here. We're going to put that in down here. So anything that's related to loans is in that fourth section here, the borrowing section. Both borrowing and repayments of that amount, and even repayments of interest. But everything else that's going to be in this cash budget is cash collections, that's monies coming in, and cash going out, except for financing, which goes into this third section. So once we've got the cash collections, the total cash we expect to have available, and the total disbursements of cash, we then have a subtotal, right? And so what do we have here? If we expect to have both cash on hand of $40,000 and collections of $170,000, well, we're expecting a total cash of $210,000, and we're going to have total disbursements of $230,000. That means we expect a deficiency of $20,000. And remember, our company has a minimum amount of cash on hand that we want to have of $30,000. So what are we going to need to do at this month? Yep, we're going to need to borrow $50,000 to cover the deficiency we expect of $20,000 and to maintain that minimum balance of $30,000 cash to meet any of those unexpected requirements. Remember that our company has that minimum requirement of $30,000 cash. So that $30,000 is what we expect to be our ending balance of cash after we have the following collections, the following disbursements, and the following borrowing. We expect to have $30,000. So our beginning balance of May, of course, is going to be our ending balance from April. So we'll go ahead and populate in that $30,000. Remember, we're getting that cash collections from the last schedule of cash collections that we created. Total that up, and that's our total cash we expect to have available for the month of May. Populate in all the cash disbursements for the month of May once again, and subtract that out. We expect to have an actual excess of $30,000. Now, can we pay back any of the borrowing? No, we can't, because remember, we have a minimum requirement of $30,000, so we're just going to have enough. We're not going to need to borrow anymore, but we also can't repay anything because we need to keep that cash on hand to be our minimum. And once again, whatever our ending balance is in one month is our beginning balance for the next month. populate in those amounts, again, getting that cash collections from our schedule that we created. Getting our total cash available, we populate all the disbursements of cash, and now we finally have ourselves a large expected excess of cash, which means what? Not only do we have the $30,000 we need for our minimum balance, but we also have an excess of $65,000, which means we're going to want to plan to pay back that $50,000 loan that we took out back in the month of April, right? And pay it off as soon as possible so that we don't continue to accrue interest. Remember, in the information that was given to us, we assumed that when we borrow on the first day of the month. So we assume we borrowed on the first day of April, and we pay back on the last day of the month. So we've had this loan of $50,000 for 3 months, we will assume. The full month of April, the full month of May, and the full month of June. We're going to pay it back at the end of the month. That means we've had it 3 months or 3/12 of a year. Remember that interest rates are annual percentage interest rates. And so 16% would be if we kept it for a full year, right? We would take the $50,000, multiply by 16%, but we're only keeping it for 3/12 of the month, right? 1 quarter. April, May, and June. So we'd multiply that by 3 and divide by 12 in order to get 3 months worth of interest, which would be $2,000. So we can pay back the full $50,000 that we borrowed and the interest for those 3 months, and then we're done paying interest, right? So that payback, of course, becomes a negative amount in our financing section. Subtract that out, and this is what we expect to have on hand even after we pay back our loan and our interest. That's it for Chapter 7. Enjoy, guys.